Hello, I'm Jose Cuevas, President and CEO of Wisdom Investments. I hope you find our first video-produced quarterly markets commentary helpful. The purpose of this communication is to keep you abreast of what's happening with Wisdom Investments, the markets, and the economy. With that said, let's start with a couple of key points. As a reminder, you can access your reports in the eMoney Advisor platform in the Vault section under the folder titled Investments. Your goal report for this quarter will simply display in the Main Reports tab under the Vault. Last quarter, in addition to your normal reports, I sent you an investment roadmap report explaining your risk tolerance and its correlation to your portfolio. This report is designed to help you understand your risk tolerance level in comparison to your investments. If you want to talk more about that report, please let me know. This quarter, I've created a goals progress report for you. If I have information on file regarding your financial planning goals and we've created a financial plan together, then you should receive a report. If you haven't created a financial plan with me and you desire more details about your future goals, or if you didn't receive a goal report this quarter and you think you should have, please let me know. It's my belief that every client should have a financial plan for the future, even if it's a simple goal plan. As a reminder, if you've had a significant life change, such as changing jobs or a salary increase, your financial profile will need an update. Our last key point before moving on to the markets. The investment industry is undergoing a massive shift with the incorporation of more advanced technology and the implementation of artificial intelligence. Wisdom Investments already utilize the state-of-the-art technologies to try and give you the best experience possible. This includes our financial planning software, our risk management system, and investment analysis tools. As a steward of your resources, I'm always looking for ways to enhance your client experience. With that in mind, I want you to know that financial technology is advancing so rapidly that it's likely I'll need to make changes in the future so that you can take advantage of opportunities that could help in meeting your goals and objectives. A few of the companies I'm already working with are making strategic shifts in their technology to give you a better client experience, and that's great. My hope is that these companies continue to enhance their offerings so that we don't need to make significant changes. However, because Wisdom Investments is a boutique firm, we are nimble enough to adapt to technology trends and implement the best technology solutions for your needs. Now on to some market data. The small caps of the Russell 2000, sensitive to current economic changes, fell the furthest last quarter, followed by the NASDAQ, the S&P 500, the Global Dow, and the Dow. Rising interest rates have impacted bond prices, yields, and the US dollar. 10-year government bond yields rose in the third quarter, reaching the highest level since 2007 as long-term bond prices slid lower. For our bond investors, this isn't good news. When bond yields rise, bond prices fall. As interest rates have unexpectedly continued to increase, bond portfolios have taken a hit. It's my view that as we near the end of this cycle, you should begin to see bonds appreciate in your portfolio again. Bonds have historically been a good diversifier for portfolios to lower risk. And although we found ourselves in a bond bear market, bonds should be healthy for conservative portfolios moving forward. Oil prices near $91 per barrel at the close of last quarter rose nearly 30% since June as Saudi Arabia and Russia, the world's second and third largest oil exporters, extended voluntary restrictions on their production. When it comes to housing, sales of existing homes decreased 0.7% in August, marking the third consecutive month of declines. Since August 2022, existing home sales dropped 15.3%. The median existing home price was $407,100 in August, up from the July price of $405,700 and well above the August 2022 price of $391,700. Despite a drop in the number of sales, home prices continue to rise. Prices will likely remain elevated until inventory increases. Now on to some more intricate market data. The current price-to-earnings ratio of the market is currently 17.8, which is slightly elevated compared to the 25-year average of 16.76. While the price for the market is slightly elevated, how expensive stocks are matters for your portfolio. We want to ensure that your portfolio is constructed in a way that is relevant to current market conditions, and price is a significant consideration. Corporate earnings are expected to continue to grow in 2024, and market growth is dependent upon growing corporate earnings. Stock market returns are primarily based on how profitable companies will be in the near future. While there are a number of market concerns at this time, growing corporate earnings is a significant positive for the markets. Another factor to consider is that right now we're experiencing tightening credit conditions. Credit tightening conditions have often indicated that a recession could be on the horizon. Whether this is a chicken and the egg type of correlation isn't fully known. But when banks begin to tighten up their lending standards, it's apparent that there is a ripple effect in the economy. When companies can't obtain the capital needed to grow their businesses, a slowdown naturally occurs. When it comes to interest rates, it's likely that the Fed increases interest rates by another 25 basis points before the end of the year. In addition, Jerome Powell has shared that he expects interest rates to remain higher for longer than they expected. This doesn't come as a surprise to me, as I've shared with many of you that I thought interest rates would remain higher than the Fed was previously projecting. We still have a considerable amount of recession chatter going on. Some of you have already heard me say that this is going to feel like an uncharacteristically long recession. The reason for this is that the financial media has been talking to us repeatedly about a recession. A recession has been quote-unquote imminent for almost 2 years now. Actually, we experienced the textbook definition of recession in the first and second quarter of 2022. The National Bureau of Economics reviewed that data and stated that the U.S. economy, while experiencing the textbook definition of recession, wasn't actually in a recession. They concluded this because some of the data, like non-farm payroll, industrial production, and retail sales, didn't indicate enough of a slowdown to constitute a recession. Now fast forward almost 2 years later, and here we are, still talking about a potential recession. The first thought that comes out of my mind is, well, but this time is different. Famous last words, right? So it's important for us to look at key indicators, both forward and lagging, to consider if this time truly is different. As an advisor, I have multiple concerns. Number one, we have an inverted yield curve. This has been a predicator of almost every recession we've ever experienced. Number two are those tightening credit conditions I talked about. We see a cause and effect relationship between tightening credit and recessions. Number three, the National Bureau of Economics recession determinants clearly indicate that we are in a cautionary time when it comes to a recession. The only category that appears to be on good footing is industrial production. Real personal income, non-farm payroll, household survey employment, real consumer spending, and retail wholesale sales all have reported cautionary numbers. Number four, the Purchasers Manufacturing Index measured in at 50.1 in September. A number below 50 for the manufacturing industry would indicate that a potential recession is a concern. But there is conflicting data. Initial jobless claims and continuing jobless claims have improved. Inflation numbers have improved significantly, which will help interest rates, which will then hopefully allow the economy to break free from the grip of government intervention. Value stocks are still historically low compared to their growth peers. For those of us who are taking a value approach, these are the kind of value premium distortions we're looking for and trying to capitalize on. Looking at a measurement of the forward-looking price-to-earnings ratio of growth and value stocks, growth stocks in the Russell 1000 are currently trading at 24.4 times earnings, while value stocks in the Russell 1000 are trading at more than a 40% difference to growth stocks at an earnings rate of 13.71. This is historically cheap compared to growth stocks, which lets us know that it's wise to continue utilizing this strategy and not abandon our long-term approach. For our more growth-oriented investors, this is the time where we want to be a little bit more careful and look at potential diversifiers for our portfolio. So what should you be doing at this time? Well, the Consumer Confidence Index has risen sharply from its June 2022 low of 50, but consumers are still concerned. The Consumer Confidence Index has a historic average of roughly 85, and the index is currently measuring at 68. This is an improvement, but tells me that many of you are probably still uncertain about the markets, their conditions, and your financial future. Here's what we know. As investors, it's important to have a philosophy and stick to it. Unless you believe your philosophy is flawed, as we incorporate Nobel Prize-winning theories to your investment approach, I want you to have the confidence that sticking to your long-term approach should pay off. It's also advisable that you continue to invest. Dollar cost averaging is a great way to increase your investment and potentially decrease volatility if you're in a time where you're saving money. Finally, stay diversified. Your investment portfolio should be allocated throughout the markets to ensure you remain properly asset allocated. Lastly, schedule a time for your review. As we try to bring you relevant information about the markets, nothing can replace your need for a review about your unique situation with your financial advisor. I'd like to thank our partners at Fidelity, JP Morgan, Guggenheim, Vanguard, and Dimensional Fund Advisors for their resources in the production of this video. I'm Jose Cuevas with Wisdom Investments, and thank you for watching.